Hey everyone, so in this video we're going to be going over exercise 2119 from the chapter 21 post assignments. So the problem gives us a lot of facts. I'll just read over them, but we'll break them up as we go through the problem. So first, World Company expects to operate at 80% of its productive capacity of 50,000 units per month. At this plan level, the company expects to use 25,000 standard hours of direct labor. Overhead is allocated to products using a predetermined standard rate of 0.625 direct labor hours per unit. At 80% capacity level, the total budgeted costs include $50,000 of fixed overhead costs and $275,000 of variable overhead costs. And then finally, in the current month, the company incurred $305,000 in actual overhead and 22,000 actual labor hours while producing 35,000 units. The problem also says just to not round your intermediate calculations. So let's get into the problem. First, it wants us to compute the predetermined standard overhead rate for total overhead. There's a few steps we need to go through to get there. So first, we need to find the fixed overhead rate. This is found by taking the $50,000 of fixed overhead costs and dividing it by 25,000 direct labor hours, abbreviated as DLH. This gives us the fixed overhead rate of $2 per direct labor hour. And those 25,000 direct labor hours is the standard hours calculated by the company. Then we need to find the variable overhead rate, which is found by taking the $275,000 in variable overhead cost and dividing it by that 25,000 direct labor hours to give us a rate of $11 per direct labor hour. Then the total overhead rate is going to be the $325,000 divided by 25,000 direct labor hours to give us a rate of $13 per direct labor hour. Or another way of calculating this is taking those two rates we found and adding them together. So the $2 per direct labor hour of fixed overhead rate plus the $11 per direct labor hour variable overhead rate to give us 13. And this 325 here is the summation of $275,000 in variable costs and $50,000 in fixed costs. Then we are going to compute the total overhead variance. So again, there's a few steps we need to go through to get this variance. First, we are going to take the total actual overhead, which is given to us of $305,000. Then we are going to take the total standard hours of actual production, which is going to be found by taking the 35,000 units and dividing them by that predetermined standard rate of 0.625 direct labor hours per unit, which gives us the total standard hours of 21,875. Then we are going to find the applied overhead, total overhead. This is found by taking that rate that we found on the last slide of $13 per hour and multiplying it by that total standard hours that we just calculated of 21,875, which gives us a total applied overhead of $284,375. Finally, we can come to the total overhead variance, which is going to be found by taking that $305,000 at the top of the slide of the total actual overhead and subtracting the applied overhead of 284,375 that we just calculated. And this would be an unfavorable number as our applied overhead is only about 284,000. That's kind of the amount that we accounted for based on predetermined rates, but we actually incurred $305,000. So we incurred more than we planned on. So that would be about 20,625 unfavorable variance.